5. Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk today, we have Andy Baehr, Managing Director at CoinDesk Indices, Leo Mizuhara, CEO of Hashnote, and Jason Allegrante, Chief Legal Officer, Fireblocks. They join me to discuss growth and adoption in digital assets and comprehensive approaches to building out a regulatory framework. Gentlemen, it is great to have you with us. Welcome to Trade Talks, and let's kick this off and discuss key trends that we saw in 2023. Andy, starting with you, it feels as if things matured a little bit this year.
They sure did, Jill. The last time I was here, Bitcoin was at around 28,000. It was just the end of the summer, and gosh, we were just like looking for any kind of catalyst that was going to take us out of the listless and kind of low volume market conditions, low volatility, trendless prices, low volume. We were really kind of stuck in the mud, and ever since mid-October, things have really perked up. So Bitcoin grazed $44,000 today on a pretty clear uptrend. Volume is higher, volatility is higher in a good way, right? Showing upside skew, meaning more momentum and more volatility towards upside trading. Ether almost as strong in around the 2,200, 2,300 level. Our trend indicator for Bitcoin has been solid green, basically significant uptrend since late October. So it's really been a change. And so why has this happened? First of all, we got rid of a lot of the baggage from 2022. Court cases gave us some resolution. We seem to have a much clearer path towards adoption of ETFs in the early part of next year. Regulation in different parts of the world, specifically in Hong Kong, are taking shape, which are allowing the proliferation of more funds and exchange products. So things are healthier. We're seeming to have resolved in a confidence-inspiring way some of the ill behavior from last year, before ignoring even macro topics, we're just on firmer footing right now, and prices are showing that.
Yeah, and Leo, you identified tokenization and stablecoins have really entered the vernacular this year.
I think that's right. Stablecoins have been a driver of digital asset adoption for a long time now. However, in this upcoming year, I think we're going to see a lot more tokenization of different types of assets. We should be specific about what we mean by tokenization, but we'll get into that later. And stablecoins are a changing ecosystem right now. We saw a big shift from USDC to USDT market cap over the last year. But I think in the upcoming year, we're going to see a lot about stablecoins, but also yield-bearing stablecoins and other yield-bearing tokens in general, which is going to be a big shift for people looking for safer ways to earn yield than the traditional DeFi yield farming strategies that people have been using in the past.
Yeah, and Jason?
We're really focused on regulation. We've long operated under the thesis that clear legal rules and regulations will be a catalyst to institutional adoption. I think we've seen that in some of the use cases the panelists have talked about already. We've seen tokenization use cases take off in places like Australia, where they are open to experimentation with stablecoins. I think in 23, we've seen globally a lot of regulation adopted, right? So we've looked very closely at places like the UAE, like Singapore, like the UK, and of course like Europe, where MiCA has been adopted. And I think in 24, our eyes turn to the United States to see what we might do here.
Yeah, I think getting a regulatory framework, especially in the U.S., really would be the next catalyst for this. I mean, even if you look at domestic asset managers, they really, there's regulations, right, as an asset manager that you have to adhere to, and without that available for digital assets, it is a big roadblock when it comes to institutional adoption.
Sure, I think it can feel a bit like a challenge at times in the United States these days. However, there are a number of things happening that I think are really positive. We have bipartisan bills introduced by Senators Lemus and Gillibrand. We have a terrific stablecoin bill out of the House Republican committee. And I think there's a lot of reason to be hopeful looking at the potential for an ETF in the first quarter of the year. So I think there are a number of things happening in the United States that could really change the tone of the conversation.
Yeah, and if we get a spot Bitcoin ETF approved,
we'll finally be able to digest that first big bite of digital assets in the United States, and that will help do two things. First of all, it'll make it easy to allocate. So anybody, retail advisors, institutions can allocate to Bitcoin and get that first important allocation done. Then the question will be what's next, right? Will Step 2, be focusing on Ether and the Ethereum network, and if so, how are they going to deal with the staking yield, which is really an integral part of the Ether investment case, and really kind of the only natural, legitimate kind of risk-free rate inside of digital assets. And then where do you go from there, right? Because there's many more digital assets, many more use cases, sectors. What becomes the new unit of digital asset exposure? All of that stuff has to come after we make this first, kind of pass through Bitcoin and get comfortable.
Yeah, in our perspective, it's impactful across multiple levels, right? It's not only that the institutions themselves come into the space of creating the ETFs and offering them. At the investor level, this is an asset class that's gained, I think, 150% roughly year over year. And I think for investors to have the opportunity to get exposure to this asset is really a game changer in the United States.
Ironically, I actually think that the ETF itself might not be in itself the catalyst. It's not that people need the ETF to invest, but for a lot of institutions, having that halo of it's okay to invest now. You now can invest in Bitcoin, and it's an institutional asset, will actually just open people up to be able to do these things. Like there are RIAs, for example, who are already allowing their investors to do spot Bitcoin. However, there's still a stigma around like crypto is not a real asset. But now that we have the ETF, I think there's going to be a lot of adoption. That's not necessarily just the ETF itself, but other ways to invest that people are going to be open to.
I couldn't agree more with that point. And the aspect of that seems to hit me every day is it won't be news anymore, right? Once the ETF is out, it stops being top of the fold news, and we stop looking at S1s and 19B statements and things like this, and we just kind of move on. That means the distribution engine that's serving this market will begin to say, okay, it's time for us to learn more. It will bring in new news stories and new asset class stories. It'll bring in new, economic research. So I think, yes, it's not just that will solve all the problems, but getting it out of the way kind of christens the asset class and lets us move on to thinking about something else.
Yeah, and people start to look for innovation in this space as well, right? Like we're looking at the Bitcoin ETF. It's going to be followed hot on its heels by an Ethereum ETF, but no one's going to want the Ethereum ETF, right? We all know that what we want is the staked Ethereum ETF. That's not going to come for a long time, is my suspicion. But there are going to be providers, I guess, like ourselves, who are going to be able to provide that Ethereum staked ETF or not ETF, I suppose, fund. And in a situation where there's a stigma around investing in digital assets, people aren't willing to do that. However, in this new world where people are investing in ETFs and this is no longer a stigmatized asset, suddenly you look at the innovation that an RIA brings saying, I have a staked Ethereum ETF, and that looks a lot more attractive compared to the Ethereum ETF, as opposed to before when you were like, I'm never going to touch any digital assets and my wealth advisor won't let me.
Yeah, well, I mean, you made a point earlier that you're looking for other sources of yield or alternative ways to drive yield in a portfolio. I mean, there's always that debate, 60-40 is dead. So where are we looking for alternative? That's not the debate here, but alternative sources to derive yield in your portfolio. So that could be a use case for it. But it's interesting when there's so much consensus on one side that once we get this approval for the ETF, then it's to the moon, right? You don't want it to be a sell the news kind of event either. So to your point, Andy, let's get this out of the news cycle and just treat it as business as usual.
Business as usual. And then the question in the United States specifically is what's going to be the last mile delivery mechanism, right? One thing that we always kind of realize is that last mile for things like buying a house or buying healthcare or financial services, the familiar, well-paved, well-regulated, trusted last mile delivery system is what is going to prevail in the end, right? One of the, we hear statistics that 50 million Americans own crypto, and that's a great statistic. It's been a great hobby for some folks. It's been something to dally in, but many fewer people have kind of gone all in on putting their entire financial planning around digital assets. And that would be kind of a little bit early to do that anyway. Having the last mile be paved with familiar structures is important. ETFs, if we continue to go one by one down the digital asset thing, we're going to be at that a long time, and that's going to be a tricky thing. So how do you get broader market exposure? What do you consider the unit of digital asset exposure? There are some great separately managed account platforms. They remain niche, but they're much more agile. where does it shake out, and what's the delivery mechanism? I think that's one thing we're going to solve in 2024, and I think that's going to make next year's conversation at this table much more interesting.
I think it's largely solved, right? Like, the mechanism is going to be a fund, and it has been for every single asset class out there. People create funds, they make it easy for people to invest through your traditional methods. I think index funds will be a big piece, so being able to know what to index to and then provide the fund that indexes to that, provide funds that are no longer stigmatized, that can invest in a broad variety of assets. And ultimately, I've always been of the opinion, so I do self-custody my crypto. However, I don't think that's for everybody, right? And so we use Fireblocks, actually, and I think Fireblocks is a great product, but it's not going to be your consumer product. So ultimately, you're going to be trusting in your fund manager or your custodian to be able to hold on to these digital assets. But the last mile, I think, is always going to be a fund, at least for the time being.
As an infrastructure company, we think about this all the time, the last mile, right? And so just as an example, take it in the tokenization context, right? We see a lot of interest from issuers or minters of the token, and we have the capability on platform to help them mint those assets. What you need is a buyer. You need the distribution mechanism, you need the buyer, and hopefully you have a secondary market because that buyer might want to turn around and sell. And everyone downstream needs a wallet or a custodian too. And so there's an infrastructure challenge here that we're thinking about very deeply, and I think the industry is hopefully, as you said, in 24 on the path to meeting that challenge.
Yeah. Well, let's talk about 2024 for a moment here. And before we get into that, Leo, I want to take it back to you. You had made an interesting point off camera that digital assets, the way that the space has grown up, is very different than, let's say, other traditional asset classes, more from the bottoms up. Explain what you mean by that.
Yeah, so we were talking a little bit about how crypto and DeFi is the first financial market, first financial asset that has really been bottom up. It's retail first, moves to institution. And every other product has always been institutional first and moved down to retail. However, in my opinion, this isn't a uniquely crypto phenomena. It's actually a social phenomenon that's going on in the world at large. We see the same thing happening in media. We see the same thing happening in retail. There's a lot more of this ability to go bottom up in every single industry, and it's a sign of our times. So to some extent, we should stop thinking of ourselves as particularly special. We are just particularly regulated.
Yeah. Well, I mean, look at the fintech space. The whole advent of it was to solve problems for customers. It wasn't like, okay, here's your mutual funds, this is what you can have in your portfolio, an institution directing where you can allocate your assets, but really I feel like the fintech space is listening to what consumers need, solving those problems. Cross-border payments was a problem. It's a big industry now. So I feel like, newer technologies and certainly as we move forward even beyond 2024, it's more about problem solving and more individualization.
Yeah.
Yes, and getting track record, right? The one thing that you can't invent, no matter how well you're capitalized, is something that's 15 years old, right? And as Bitcoin reaches 15 in 2024, it's been resilient. It's been resilient through market cycles. It's been resilient through macro cycles, its own cycles, through adolescent behavior of the market participants, right? And it survived, and it looks very strong right now. That might not have happened under institutional sponsorship from day one, right? The people who have used this as a hobby, not everybody came out unscathed, but there was a large population of people who found this very interesting and worthy of their time on a volunteer basis or on an individual basis. And that's how we got to where we are 15 years later. And now institutions can look at it and say, okay, well, this thing has been resilient through just about everything I can think of. I think it's time to really take a closer look at it.
Yeah, I think that's a great point that you make, that if we would have had an institutional wrapper around it, it might not have been able to mature more naturally on its own for those reasons that you just stated. So let's talk about 2024 outlook here, and it doesn't necessarily have to be just about Bitcoin and Ethereum pricing and trading ranges. Just more holistically, what are your expectations for 2024?
2024 is going to be the year when Bitcoin is still an important digital asset, but won't be the reference for digital assets. We're going to move into an asset class state where we really think about sectors, where we think about correlation of different tokens, where we think about an ecosystem. That's really the thing that we thought might have happened this past year if we hadn't had the setbacks that we had. sectors and index funds, as you mentioned before, passive investing, correlation, diversification benefit, things like that. A lot of the regulations in different parts of the world are supportive of funds, both retail and institutional, that will support that kind of standardization. So I'd say the number one prediction is that when you hear digital assets, you're going to hear about an index, not necessarily about Bitcoin anymore.
Yeah, I mean, I think that would be a great thing in terms of maturation. It's not like saying Microsoft is the stock market. It's not like Bitcoin is the digital asset space. I think it's a great context to think about it in terms of sectors and indexes. What about tokenization?
Yeah, I think tokenization will be a big part of it. So when I think of 2024, I think three major growth patterns in this market. So first, it's going to be the fact that a lot more people are going to get access to the market via these funds, via these structures that are easy to get into and now are no longer a problem for people to get into. The second thing is going to be tokenization. It's going to be this idea that, and it's not, so I think tokenization is often misrepresented. In my mind, when people are taking specifically a security, right? If you take, say, an ETF and tokenize it, totally useless. Like you're adding this layer of risk, which is protocol risk. You're adding this layer of fees, and you're creating this product that is lower return, higher risk. From my chief investment officer seat, like looking at it as a CIO, I can never invest in that versus a traditional asset. However, true tokenization in my mind is when we skip that middle layer of like the ETF or whatever the securitization that is happening on the TradFi layer is, and skip straight to taking the actual asset and moving it on chain. So what does that mean? If we're thinking about what we call asset-backed securities in TradFi space, right? There is this cash flow that moves to a servicer, that moves to a banking provider, that moves to another servicer, that moves to the cash flows for the security. That should all be disintermediated, and you should be able to take a cash flow directly on chain, move it into a smart contract, have all the process done via the smart contract, and you've taken a layer of fees out. And on top of that, you've added transparency to this whole banking system. I've actually had instances where my brokerage accounts got random interest paid to me by some random security that I did not own. It was just an operational mistake, right? This sort of thing should never happen. And the blockchain allows us to do these new types of tokenizations that will allow these products to move natively on chain. Honestly, in my mind, when I think of stocks, right, equities are a digital asset. There's no physical thing you're really tying back to, right? It's not like gold or real estate. And so things like equities should move on chain. They should be on-chain native assets. And so in my mind, the world moving toward tokenization is going to be moving toward native settlement of many of these financial transactions on chain. So that kind of brings me to my third kind of vector of growth for 2024. I think stablecoins and yield-bearing stablecoins are going to have a huge year. We're going to start getting real adoption of the usage of these products. We see PayPal coming online with their PayPal USD, right? Where do we think that's going to go? That's going to go into the PayPal app. It's going to go into eBay. It's going to go into Amazon. And it's a very natural way of doing payments, right? But once you've got people on this stablecoin, I want to say entry-level drug, right? At that point, you start using this everywhere. You start to make this easy to use, within the permission space, within the unpermissioned space, in general, around these new ways where people want to go and invest their monies in ways that they weren't able to do before.
Right.
So I think we're going to see all three of these being very, very large growth vectors in 2024, really buoyed or supported by the stablecoin adoption in 2024.
And Jason, finally, from the regulatory perspective.
Sure, absolutely. I see the industry as being at an inflection point. I think there are factors internal to the industry that we have had the opportunity to reflect upon and internalize. What I'm thinking of is a pivot away from volatility use cases only to actual practical use cases. Again, things like stablecoins, focusing on stablecoins. And I think the industry continues to mature. I think there's a realization now that the expectations are that we are a mature industry, that we play within the confines of the rules. And I think it will be good for everyone to get that message and kind of go into 2024 expecting to play at a level playing field with everyone else. I think there are external developments as well. Again, the regulatory developments. What we've seen, to summarize at a high level, are countries more or less moving on their own at this point. And this is actually, I would argue, unusual. The last time we had a financial crisis, looking back to 2008, 2009, we had coordinated effort coming out of the G20 with a principled announcement of reforms. We have not had that coordination yet. It may be that in the world of 2023, that kind of political cross-global coordination is no longer possible.
Such a good point. I was just thinking the other night, when you think about other asset classes, you have sovereign asset classes
Yep.
and high levels of international coordination. And now you have a global asset class and no international coordination.
Exactly.
It's just the worst of both situations.
For the first time in a long time, we actually have the ability to compete on that ground, right? I think the UAE is doing a great job
Yes.
of competing in the space and taking assets and taking mind share from the rest of the
That's
world.
funny. So not competing on markets and the valuation of the assets underneath, but competing on the regulatory speed of the government.
Absolutely. and the market share that I think we're talking about is market share in the internet economy. And I think what Leo was describing with stablecoins are that stablecoins are the currency of the internet. We haven't quite gotten there yet, but it will become apparent. So we're in a world right now where we have different nation states moving at different speeds. We'll see if coordinated effort comes out of this in 2024. But as Leo pointed out, I think there is opportunity for entrepreneurial nation states to take market share of the internet economy.
All right, we will end it on a positive note. Thank you so much for joining us on Trade Talks. And thanks for joining me from the Nasdaq market site. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.